Trump's 2025 tariffs, a bold strike against China, or a ticking time bomb for the U.S. economy? Right now, America is at a crossroads. The economy is shaky, inflation is still biting, and global trade, it's shifting faster than ever. And just when the world thought U.S.-China tensions were stabilizing, Trump is back, and so are his tariffs. In 2018, he launched a trade war, slapping billions of dollars in tariffs on Chinese goods. Some called it a masterstroke, others a disaster. Now in 2025, he's doing it again, but bigger, bolder, and riskier. A new wave of tariffs is hitting key Chinese industries: technology, manufacturing, and agriculture. The goal? Bring jobs back to America, strengthen the U.S. economy, and weaken China's dominance. But here's the real question. Will it work? Or will history repeat itself, hurting American businesses, driving up prices, and dragging the economy into another storm? Today, we break it all down. How will these tariffs impact the economy? How is China fighting back? And most importantly, is this Trump's smartest move yet? Or a costly mistake America will regret? Buckle up, because this trade war is just getting started. Let's break it down. What exactly are Trump's 2025 tariffs? This time, it's bigger, broader, and more aggressive than ever before. The new tariffs target three major sectors: technology, manufacturing, and agriculture. Chinese semiconductors, batteries, and AI-related products now face tariffs of up to 50%. That's a major blow to companies relying on Chinese tech. Electric vehicles, solar panels, and steel, 40%. The goal? To bring back American manufacturing, but at what cost? Even agricultural goods, soybeans, seafood, and processed food are seeing tariffs between 25% and 35%. That means higher costs for businesses and higher prices for consumers. The message? America first, China last. But will this really help the U.S. economy or just create new problems? Let's compare. How does this stack up against past trade wars? Back in 2018, Trump launched his first tariff war against China. He imposed a 25% tariff on $250 billion worth of Chinese goods. The goal was to pressure Beijing into fairer trade practices. The result? A supply chain crisis, higher prices, and global market instability. Many American farmers suffered. U.S. companies paid billions in extra costs. And guess what? China didn't back down. Then came Biden. He kept most of Trump's tariffs but tried a different approach. He offered exemptions for industries struggling with supply shortages. He also avoided escalating the trade war. Instead, he focused on strengthening economic alliances with Europe, Japan, and South Korea. But now, Trump is taking an entirely different path. These new tariffs are double, even triple what they were in 2018. And this time, China isn't the only target. Key U.S. trading partners, Japan, South Korea, and the European Union, are also in the crosshairs. That means retaliation is coming. China is already preparing its countermeasures. In 2018, they slapped tariffs on American soybeans, pork, and automobiles. This time, expect even harsher responses. The real question now isn't just how China will respond, but how the entire world will react. And that could change everything. Trump has long argued that tariffs are an essential tool to protect American jobs and reduce China's growing economic power. He believes that the U.S. needs to push back against China's unfair trade practices, which he claims have led to massive job losses, particularly in manufacturing. Trump's rhetoric often focuses on bringing back jobs that have been outsourced to countries with cheaper labor costs, and China, in his view, has been the primary beneficiary of such global shifts. By imposing tariffs, he asserts that American businesses will be forced to shift production back home, stimulating job growth in the U.S. This, according to Trump, is not just a matter of economics, it's a matter of national security. He argues that reducing China's economic influence will give the U.S. more leverage on the global stage and prevent further economic dependency on a rival superpower. But there's also a political angle to these tariffs that can't be ignored. With his eye on the 2028 presidential election, Trump may be using the tariffs to solidify his voter base. By positioning himself as a fierce protector of American workers and a staunch adversary of China, he hopes to appeal to his core supporters, particularly those in the industrial heartlands of America, where job losses due to outsourcing have hit hardest. These voters, many of whom were a key part of his support in 2016, are still deeply concerned about globalization and the outsourcing of jobs. Trump's trade policies are framed as a direct response to their concerns, offering them a sense of reclaiming control over their economic future. Looking back at the 2018 trade war, it's important to ask, did these tariffs achieve their intended goals? Trump's administration aimed to reduce the U.S. trade deficit with China and bring manufacturing jobs back to the U.S. However, the results were mixed at best. While some manufacturing jobs were indeed brought back, many were offset by rising costs for consumers and businesses. The trade war also hurt American farmers, who were heavily impacted by retaliatory tariffs from China. While Trump claimed victory in the form of a Phase 1 trade deal, many of the structural issues in U.S.-China trade relations remain unresolved. This raises questions about whether the 2025 tariffs will deliver on the promises of job protection and economic rebalancing, or whether they will simply escalate tensions and lead to further economic strain for everyday Americans. As we move into 2025, the stakes are higher than ever. The question remains, will Trump's tariffs prove to be a long-term strategy for economic revitalization, or are they simply a temporary fix that could create more harm than good? Only time will tell. China has not stood idly by in the face of Trump's new tariffs. In fact, China's response has been swift and strategic, targeting key sectors of the U.S. economy. The Chinese government quickly imposed its own set of retaliatory tariffs on American agricultural products, such as soybeans, pork, and cotton, which are essential to many U.S. farmers. These sectors were hit especially hard during the 2018 trade war, and the 2025 tariffs have only amplified the pressure. But agriculture isn't the only area China has focused on. They've also targeted semiconductors, an area crucial to the U.S. technology industry. Given that many of the world's top semiconductor companies are based in the U.S., China's tariffs on these products are a direct challenge to American technological leadership. Furthermore, energy exports from the U.S., particularly liquefied natural gas, LNG, have been subjected to additional tariffs, further hurting a sector that was previously a key player in the trade balance between the two countries. But China's retaliation doesn't stop at tariffs. Over the past few years, China has been working hard to strengthen its trade alliances across the globe. One of its main focuses has been Europe. With the U.S. taking a more isolationist approach under Trump, China has seized the opportunity to deepen its economic ties with European nations, offering trade deals, infrastructure investments, and access to its vast consumer market. In addition to Europe, China has also built stronger trade relationships with countries in Africa and Southeast Asia through initiatives like the Belt and Road Initiative. These new alliances are not just about economic cooperation, they are a strategic play to counterbalance U.S. influence and reduce China's reliance on American markets. By diversifying its trade relationships, China is not only protecting itself from the impact of tariffs, but also positioning itself as the leader of a new global economic order. As China strengthens these alliances, it is also exploring ways to bypass the U.S. altogether. One of the most notable developments in this regard is the rise of the yuan in global trade. For years, the U.S. dollar has been the dominant currency for international transactions, but China is actively working to change that. Through initiatives such as the internationalization of the renminbi, RMB, China is encouraging countries to use the yuan in trade deals, particularly with countries that are part of its new trade alliances. This move is not only about undermining U.S. economic power, but also about establishing China as the central hub of a new, dollarless trading system. As more countries begin to use the yuan, it could signal a shift in the global financial landscape, weakening the dollar's hold on international trade and giving China more influence in global economic affairs. While the US and China battle it out over tariffs, it's becoming increasingly clear that China's strategy goes beyond retaliation. The country is positioning itself as a global economic leader, expanding its influence while actively working to reduce its dependence on US markets and the US dollar. Whether or not this will pay off in the long run remains to be seen, but what is certain is that China is no longer simply reacting to US policies. It is actively shaping the future of global trade. As the tariffs continue to escalate, the real question is, who bears the brunt of these trade policies? For many Americans, the answer may not be who they expect. American consumers, it turns out, are likely to be the real victims of Trump's 2025 tariffs on China. The tariffs have led to higher prices on a wide range of goods, from electronics and automobiles to everyday consumer products. These price hikes are the result of increased costs for manufacturers, who often pass those costs on to consumers. Take tech products, for instance. U.S. tech companies reliant on Chinese manufacturing are facing higher costs for components such as semiconductors, which could lead to price increases for items like smartphones, laptops, and even electric vehicles. It's not just luxury goods either. Everyday essentials like clothing and household items could also see their prices rise, making life harder for American families already grappling with inflation. On top of rising prices, there's also the issue of supply chain disruptions. The global supply chains that have become so crucial to the functioning of the U.S. economy are already feeling the strain. Many industries that depend on Chinese manufacturing are encountering delays and even shortages of key components. Take the automotive industry, for example. U.S. automakers, who rely on Chinese-made parts and materials, are facing production slowdowns, and in some cases, entire factories being idled. This disruption not only hurts the automotive sector, but also trickles down to the millions of workers whose livelihoods depend on the industry. Agriculture, too, is feeling the heat. With China imposing retaliatory tariffs on American farm products, U.S. farmers are facing diminished access to one of their largest markets. Crops like soybeans and pork are particularly vulnerable, and farmers are seeing their profit margins shrink as they are forced to find new markets, often at lower prices. But the impacts of these tariffs don't just stop with consumers and industries. Wall Street is also taking note of the situation. The stock market has been volatile in response to Trump's tariff policies. Investors are jittery, unsure of the long-term consequences these trade wars might bring. In particular, U.S. multinational corporations, which have strong ties to China, have seen their stock prices fluctuate dramatically. Companies in the tech and automotive sectors, whose production relies heavily on Chinese components, are facing pressure as their costs rise. Meanwhile, companies in agriculture are experiencing sharp drops in stock value as trade uncertainty looms. The financial markets are highly sensitive to these developments, and the uncertainty surrounding tariffs could make investors wary. So while the narrative around these tariffs may focus on the impact on China, it's clear that the U.S. economy, particularly its consumers, industries, and stock markets, is already feeling the real consequences. Higher prices, supply chain disruptions, and volatile financial markets, these are the true costs of the 2025 tariffs, and they may continue to reverberate throughout the U.S. economy for years to come. As Trump's trade war intensifies, it remains to be seen how much more the American public will be willing to bear before they demand change. As we dive deeper into this new trade war, it's crucial to look at who stands to win and who's likely to lose. The shift away from China as a major supplier to the U.S. presents opportunities for other countries to step in. Could Mexico, Vietnam, and India replace China in U.S. supply chains? It's a possibility that many are exploring. Mexico, for instance, is already benefiting from its proximity to the U.S., making it an ideal alternative for manufacturing goods. Its growing manufacturing sector, particularly in industries like automotive and electronics, could absorb some of the demand previously directed to China. Vietnam, similarly, has been a rising star in the global supply chain, particularly in electronics and textiles. Companies looking to diversify away from China have found Vietnam an attractive option due to its low labor costs and favorable trade agreements. And let's not forget India. India's vast workforce and expanding tech sector make it a strong contender to fill some of the gaps left by China, especially in areas like software development, pharmaceuticals, and textiles. However, while these countries are stepping up to the plate, the transition is not without challenges. Shifting supply chains is a complex and costly process, and it remains to be seen how quickly these countries can fully absorb the demand. But while some countries might benefit, there are significant risks that could come from these trade tensions. One of the biggest threats is stagflation, a dangerous economic scenario where inflation rises, but economic growth stalls. Could the tariffs, especially when paired with existing inflationary pressures, push the U.S. economy into a recession? There's a real possibility that higher prices due to tariffs, coupled with disrupted supply chains, could slow down consumer spending, while businesses face rising operational costs. The fear is that the U.S. could enter a period of economic stagnation, where inflation remains high, but economic growth fails to pick up. If that happens, both businesses and consumers will feel the pinch. The political implications of stagflation would be significant, as it could lead to mounting public dissatisfaction, which might shift the political landscape in unexpected ways. On the flip side, global investors are already recalibrating their strategies in response to the new trade environment. Investors, who thrive on stability and predictability, are closely monitoring these shifts, and many are adjusting their portfolios accordingly. In the face of tariffs and trade disruptions, some are moving towards markets that appear to be more insulated from the effects of the trade war. Emerging markets, such as those in Southeast Asia and Latin America, are seeing increased interest as companies look to diversify their supply chains. At the same time, some investors are looking to invest in U.S. tech companies that could benefit from reshoring efforts or that might not be as heavily impacted by China-specific tariffs. Other investors are looking to hedge against potential inflation by moving into commodities or precious metals like gold, which tend to perform well when inflation is rising. In short, while the trade war presents a clear set of winners and losers, it's clear that the global economic landscape is undergoing a significant shift. As companies pivot their strategies and markets adjust to new realities, it remains to be seen how long the ripple effects from these tariffs will last. The next few years will be crucial in determining which countries and sectors thrive, and which ones struggle under the weight of a new, volatile economic environment. When we look back at history, trade wars have often been a double-edged sword. While they may start with the aim of protecting domestic industries or changing the behavior of a trading partner, the results are rarely as clear-cut as the initial intentions. Take the Smoot-Hawley Tariff Act of 1930, for example. It was designed to protect American businesses during the Great Depression, but ended up worsening the global economic downturn, leading to retaliatory tariffs from other countries. History tells us that trade wars can escalate quickly, causing long-term economic damage that extends far beyond the immediate targets. So while tariffs may seem like an attractive short-term solution to curb foreign competition or push for more favorable trade terms, their consequences are often more complex and harder to control. Now, as we look at the question on everyone's mind, will tariffs actually work this time? The truth is, it's still too early to say. The tariffs imposed during the 2018 trade war didn't exactly deliver the results President Trump promised. While some industries, particularly in manufacturing, saw growth in the short term, the long-term effects were more ambiguous. Many American consumers ended up paying the price for these tariffs as the cost of goods increased. Additionally, the trade war strained relations with allies and disrupted global supply chains. Now in 2025, with a new wave of tariffs targeting China, we have to ask whether the strategy will be different this time. With the rise of new trade alliances, the global economic landscape has changed. China's ability to shift its trade patterns and the growing influence of other countries in global supply chains may reduce the effectiveness of tariffs in the way they worked in the past. It's possible that the outcome this time could be very different, both better and worse in ways we cannot yet fully predict. As we wrap up, there's one final thought to ponder. Are Trump's tariffs a bold move for America's future, or are they a costly mistake we'll regret down the road? There's no doubt that the president's policies are reshaping the landscape of global trade and U.S.-China relations. But as with any bold decision, the risks are high. If the tariffs succeed in reshaping China's economy and bringing back American jobs, then Trump's gamble could be seen as a visionary move. On the other hand, if these tariffs lead to higher costs, reduced consumer choice, and economic stagnation, we may look back and see them as a costly error, one that strained relationships with other nations and left U.S. businesses and consumers worse off. As we continue to follow this unfolding story, the future of U.S.-China trade remains uncertain, and only time will tell whether Trump's strategy was truly the right call. So after diving deep into the complex world of tariffs and their impact on the U.S.-China trade war, the question remains: how will this all play out for America's future? Will Trump's tariffs spark the economic revolution he envisions, or will they end up being a costly misstep? We've seen how history, shifting global alliances, and the unpredictable nature of trade wars can shape the economy in ways we often don't expect. If you want to stay updated on how this unfolds and get insightful breakdowns of the global economic trends, the strategies behind major policies, and their real-world effects, make sure you subscribe to Econ Atlas. We'll continue to bring you fresh, easy-to-understand analysis that's crucial for navigating these times of economic uncertainty. Hit the like button, share this video, and comment below with your thoughts on Trump's tariffs. Do you think they'll work this time? Let's keep the conversation going. And don't forget, subscribe for more in-depth videos on the world's most pressing financial and economic issues.